Welcome back to Trading Hard Times and Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Axel Merk. Axel is the president and CIO of Merk Investments, and he's manager of the Merk funds. And, he's an expert on macro trends. We've had him on this show before. He also has a great knowledge of gold, and he's also an innovative entrepreneur, capitalist, and understands gold, and has had put together one of my favorite products and one that I own, the Merk Gold Trust ETF, symbol OUNZ, trades on the New York Exchange. Welcome, Axel. Thanks for joining me again.
Great to be with you.
As I recall earlier this year, I think I might have heard you on an interview on Bloomberg. You were sort of the opinion that the euro would get stronger during 2015, and of course we're only through the first quarter of 2015, so a long time to go, and that the dollar would probably, I think, peak, and you can correct me if I've got that wrong, but so far it's been the opposite. The dollar has shown quite a bit of strength relative to other fiat currencies, and but the euro's declined on the back of ongoing Greek insolvency. Can you update us a little bit on the latest events in Greece and what that may mean for the European financial markets going forward this year?
Well, sure. Yeah. The media does pull me out when they want to have a positive word about the euro, just because I'm not as negative as others are. And I don't think anybody really wanted to catch a falling knife. But I do argue a bunch of things that one can combine and say, yep, the euro shouldn't be quite as weak. And let's just do a couple of things here. First of all, the euro has been almost in a free fall until not long ago. Actually, during the FOMC meeting that Janet Yellen had the other day, that's when it found a bottom, went to about 105, then zoomed up to 110, and is now hovering around 107. And basically, everybody and their dog appears to be negative on the euro. And no matter what you think of the eurozone, when you have such extreme positioning, that's very, very dicey, because you can get a snapback rally. Also, what happens when the volatility is induced, in this case the FOMC induced volatility, and we've had volatility since, and people are encouraged to use less leverage, and so when you have these sort of extreme positions, they tend to at least temporarily move back. Now, going more at fundamentals, Draghi, the head of the ECB, is clearly trying to print a boatload of money, convincing people that they should sell the euro. He wants a weaker euro to boost the economy, but of course the only folks that benefit from a weaker euro, other than some tourism everywhere, are the folks who are ready to export. So Germany is going gangbusters. As far as Greece is concerned, we're not as negative as many people are, simply for the reason that it is no longer financial institutions holding Greek debt. It is the ECB, the IMF, the EU. If Greece goes bust, it's a big problem for Greece, but the so-called contagion isn't there anymore, because it is the other folks that hold that they socialize the losses when the ECB and others are losing out, and so clearly some other concerns might arise, but the market clearly says that they are not terribly concerned about Greece.
So the Europeans have essentially socialized the debt, just like the United States did, in a sense, I suppose, right? That's what you're saying. It's off the balance sheets of the banks.
There's some interesting twists to it. I mean, the European Central Bank now has about 100 billion euro exposure to Greece. Now, technically, a central bank can have a negative net worth. The Bank of Israel had a negative net worth for about 20 years. It doesn't matter, except the ECB has these wonderful rules that if there were to be losses, the member countries would need to pay in. Now, rules are there to be broken, so we have to see how that's going to play out. In fact, that very rule is causing some headaches right now, because the Bundesbank, for example, as part of this QE program, is supposed to be buying German bonds, and they don't want to buy them at negative yields. Now, you got to go out many, many years to get anything that's near zero, and so the Bundesbank doesn't quite know what to buy, because if they buy them at negative yields, the Bundesbank doesn't want anybody to come up for these losses, but if they don't come up for their own losses, well, you're opening a political hot potato if ever there are Greek losses, and so this entire QE program has created nice havoc. It did weaken the euro as intended. It's going to be very interesting to see how this plays out going forward.
You know, speaking of negative rates, Axel, I have to ask you, what do you make of the Swiss negative rate, and where is that rate now?
Oh my God! Well, let me look it up as we talk where it is right now. I mean, it's been going on that
pretty
right
negative.
now in Switzerland the 10-year. Well, actually, yes, the 10-year is a minus 0.089, so slightly negative on the 10-year. And basically, people are giving the government money because they don't want to hold it themselves. There's too much capital out there chasing things. Obviously, all this QE is inducing some of that. The clear encouragement is supposed to be that you're supposed to put your money away abroad. But then again, the alternative is the dollar. And the one thing I'd like to point out to people is that the dollar has been rallying together with the markets. And that's not supposed to happen. The dollar is supposed to be the safe haven where people go to in times of crises. And the issue is that when it rallies in good times, well, if we do have a major correction in the market, which I think will happen, does that mean the dollar is going to rally in that environment? It's possible, but I wouldn't bet my house on that.
Yeah, it's. It just seems hard to comprehend the logic of paying a bank to take your money. But I guess what it means is that the Greek. It means that people have so little confidence in the purchasing power, the stability of other currencies that they're willing. And I mean, how much money can you put under your mattress, Axel?
Well, what's happening is that people are then almost forced to chase yield, to chase performance, and that's exactly what's happening. Remember in 2008 and 2007, who bought the toxic securities the last? It was the foreigners. The foreigners bought those the last. They bought the worst tranches. That's why you had these big bank blowups in Europe. And so similarly. Now it is foreigners chasing U.S. equities, chasing U.S. returns because they're scared away from bonds or just about any other security there. They're forced to buy very risky things, and this will go fine until suddenly something goes wrong, right? I mean, what can possibly go wrong?
Yeah, what can possibly go wrong? I think any number of things can possibly go wrong. You know, we had John Rubino on this show a couple of weeks ago talking about how pension funds are now buying Silicon Valley startups, you know, and how I think it was some Danish pension fund that was buying Zimbabwe bonds or something like that. So it's getting a little bit ridiculous, it seems.
Well, everybody needs to make the numbers, and so that's the sort of thing that forces them to do. I mean, the big challenge for an investor is because obviously the question is ultimately, what are we going to do about it, and why do we care? Well, the reason we care is that all this QE has inflated asset prices. Well, what happens? God forbid, the Fed is trying to engineer an exit. Well, that means asset prices might deflate again. What the Fed has done is they have taken perceived risk out of the market. Junk bonds don't appear risky anymore, Portuguese debt, whatever, you name it. And so as central banks try to engineer an exit, risk will come back, fear will come back. And because we've based this recovery on asset price inflation, the headwinds to the economic growth are going to be significant, and that pretty much ties the hands of the Fed. But it doesn't mean they won't try, because they have this make-believe world where everything is going to go play out just happily ever after. And that's really the challenge that we're in. Now, as an investor, what you want to do is you want to make sure you have something that is not correlated to the rest of the things you have. And that's pretty difficult, because anything that's not been correlated has probably gone down of late.
Well, there's not too much. In fact, there's not too much that isn't correlated with everything else these days, except I would say gold, and I'm sure that fits into your matrix of investment possibilities in a major way because of that, right?
Well, gold is one of the easiest things that people can relate to. I mean, you love it or you hate it. Over time, gold has had a very low correlation to other assets. And then the second question about gold is, of course, what's the return going to be going forward? Everybody kind of sees, over history it's done well, but what about tomorrow? And what about with rising interest rates? Well, gold is a brick. It doesn't pay any interest. But that seems pretty appealing to me when interest rates are negative everywhere else. And the question is, of course, well, if interest rates go up, where are they going to go to? And the real question there is, what is it on a real basis? What is it after inflation? And right now we're just around zero on cash. I would assert that the Fed is only going to raise rates if the economy continues to improve, which means inflation may also pick up. And inflation is, in my view, going to be higher than the interest we're going to get. In fact, I would allege that in a decade from now, we cannot afford positive real interest rates in the U.S., in the Eurozone, or Japan. And so we're going to have this bias in the system to keep interest rates low to negative, at least on a real basis. And that's an environment that works for gold. Now, the other things one can do as well, but gold is just an easy answer. Now, clearly, gold, when priced in dollars, can also be quite volatile, so it's not the solution to everything for everybody.
Sure. No question about it, but it seems to me, Axel, that when the Fed suppresses interest rates as it has, central banks around the world, the Bank of Japan, of course, too, and now the Eurozone, that what you're really doing is not allowing price discovery in the capital markets. And in my way of thinking, all that can do is result in less growth, not more growth. What do you think?
Well, absolutely. You're imposing capital misallocation, and in my view, nothing good can come of it. Now, the one place, by the way, that's moving in the other direction, although they've also been getting a lot of heat, is China. China is one of their themes that they have is they want to introduce more competition in the banking sector, not just on the deposit rates, but on the lending side, meaning they actually want to price credit according to the risk profile of borrowers. Think about that concept, right? But basically, historically, state-owned enterprises have access to credit, but small and medium-sized enterprises have to go to a loan shark. Now, if you can allocate credit more efficiently, you can unleash an entrepreneurial boom in China. It's one of the reasons I'm not as negative on China as many, many other people are. But they're moving in the right direction. Now, I'm not saying they're there, and I'm not saying it's an easy road, but at least they're moving in the right direction. Whereas, yes, in much of the rest of the world, we've been distorting the credit allocation process, and that's not good.
Axel, you just touched on the whole idea of how are we going to protect ourselves when the Fed actually starts to raise rates. A title of your March 3rd article was How to Diversify When the Fed is Out of Patience. First of all, I mean, it's hard for me to see how the Fed can do anything other than jawbone about higher rates. Do you agree with that? I mean, it's hard for me to see how they can really actually start to raise rates. They've been wanting to do it, it seems, but every time they get close to it, the stock market throws a hissy fit. And just today, I noticed the stock market is down nearly 200 points. It seems like there's so much based on the stock market and this whole idea of animal spirits. What happens if we get a sharp decline in the equity market here? And do you think that the equity market is what the Fed is watching and will actually, deter them from raising rates?
Well, I think it's the chicken, not the egg. And what I mean with that is that it is central bank policy throughout the world that has kept volatility low. The one thing central banks have achieved is, as I indicated earlier, they've taken perceived fear, perceived risk out of the market. Volatility is down. So, and what happens in that environment is, think about equity prices moving higher, volatility is low. Well, people think what can possibly go wrong. They sign up, they go into the market price moves higher. The problem is the moment volatility moves higher, the moment fear comes back for whatever reason, people say, I didn't sign up for this, and that's why everybody's going to rush for the exit at the same time. And so when central banks, and the Fed is the biggest elephant in the room, so it doesn't really matter that the Bank of Japan and the ECB still want to move in the other direction. When the Fed wants to move towards an exit, volatility is going to move up, and that's going to cause havoc in the markets. Clearly, we still have this buy the dip mentality, but as the Fed is trying to do an exit, and remember, Janet Yellen, her focus is the labor market. She is going to be aloof to what's happening in the stock market for a little bit until the stock market teaches her better, but it's going to be a while. And so volatility, in my view, is going to continue to rise. That's going to be very bad for asset prices. Now, of course, you add to that earnings momentum is slowing down, and there's some other reasons why the market might be coming down. But in my view, it is the Fed that's inducing more volatility. Also added to that is Janet Yellen's new thing that she doesn't want to say what's going to happen going forward. She keeps everybody guessing. Well, if you keep everybody guessing, that means people disagree, which is a good thing, but it conversely means more volatility. And when you have highly elevated asset prices, again, that provides headwinds to asset prices. These are all very nice ways of saying that there might be a crash.
Yeah, and but as soon as the market starts to get weak and she trots out, or one of the other Fed officials trot out to say, "Oh well, we're patient. We're not going to be in a hurry to raise rates," and then the market turns around and just heads north again. It seems.
Well, nothing happens in a straight line. A couple of years ago, I had a chat with Don Cohn. At the time, he was had been the vice chair at the Fed, and for him, it's all a walk in the park. And his response when I mentioned this to him, that this is eventually how I see things unfold, going to tie the hands of the Fed, he said, "Oh, don't worry about it. We'll just fine tune it, and then they'll just raise a little bit more and so forth." In practice, what I think it means is that Bill Gross has it right when he says the new normal is closer to 2%, meaning that they're just not going to be able to raise rates as much. And the only thing I would add to that is at 2%, we're going to have negative real interest rates. Now, I had a chat with another Fed official a couple of months ago and explained that to him, and he looked at me and he said, "Well, that's not a stable environment. You don't find an equilibrium there when you have negative rates, and that's where the Fed plateaus out." And my response to that was, "Well, I never said it's going to be stable."
Yeah, well, it seems to me that what you're describing here, Axel, is a less stable environment. While it's perceived that risk is low, in fact, from a systemic point of view, it's actually becoming greater. Risk is becoming greater.
Stability is eroding. Also political stability is also eroding in the world, and those things kind of go hand in hand because real wages haven't grown anywhere. People are upset. They vote for more populist politicians. Policymakers throughout the world never blame themselves and blame others, and they intervene in the markets. We're going to have further volatility. So yes, the safe haven cash is no longer safe, and there is no place to hide. And then basically what that means is that you have a risky portfolio and you need to work with it with the added challenge that everything is highly correlated. So yes, if you're a sophisticated investor, you can deal with it. But if you're a mom and pop saver, you're going to be on the losing end of this, and that's exactly what we see play out in the world.
You wrote another very interesting article, and I should tell our listeners that these pieces that you write are actually available to them if they sign up, right? For email delivery of your missives.
We have a free newsletter at merkinvestments.com, and you can also follow me on Twitter. Axel Merk is my handle, and follow me. I try to shed some light on some of these topics.
Would encourage my listeners to do that because there's always a lot of good food for thought and I think important information about the markets. But a very interesting article is Japan, Zimbabwe. Well, that would seem to be a ludicrous idea. And you mentioned that you were recently on a panel discussion, and all the other members of the panel thought that was a ludicrous idea. And while you admit that there's certainly a lot of differences between Japan and Zimbabwe, you found a lot of similarities to point out. Could you share some of those with our listeners?
Well, I try to give people some food for thought, and clearly Zimbabwe and Japan, the key difference is that one is an advanced economy and one is not. But there's this perception that an advanced economy cannot possibly go bankrupt. The key difference is that if you have, the similarity is if you have unsustainable policies, they got to stop at some point. But the key difference is that advanced economies, including Japan, they have many more options. And then we have unsustainable budgets in Europe, in Japan, but also in the U.S. We're probably the best at kicking can down the road in the U.S. But in Japan, we have Abenomics these days. And Mr. Abe might double down yet again if his policies are not effective enough. Ultimately, Japan did end up with a bout of hyperinflation after World War II to reset its debt level, so to speak. And that's a possible way of dealing with it. If you have a productive enterprise, you might survive it if you don't have any debt and you don't get hung up in the spiral that might ensue. The biggest fear and the biggest threat that's out there, by the way, is that these policies are working. What do you think is going to happen to bond prices if Japan had real economic growth? And if bond prices were to fall, as I would think they should if they have economic growth, what's going to happen is it's going to make it impossible to finance a deficit. So in this muddle-through environment that we're in, we're kind of in the calm of the storm. And for some folks say, if we get economic growth, everything is going to look great. There are many twists and turns this environment can take. And yes, with regard to Japan, they do have more options than Zimbabwe. But ultimately, if you have unsustainable deficits, there's no no end in sight, then that's not going to have a good ending. And by the way, I think that the way they play this is with the yen, to short the yen, because that's where the VAD is going to be. The Bank of Japan is going to keep the borrowing cost low, and the yen is the one that has to give.
Yeah, it certainly has been a good trade up until recently, but that would make sense. It would certainly make sense. But then the whole world is in the same position to a certain extent. And what's the United States going to do as its baby boomers start to drain its treasury here? It seems to me we're going to be in the same position.
Well, contracts will be renegotiated. We cannot live up to our promises. So you got to decide where you want to be on each side of these contracts, so to speak, who the winners and the losers are going to be. And in some ways, of course, as an investor, there are opportunities to either make money or to not lose as much as some other folks do. But the one thing, if you talk on a government level, interests of governments are not aligned with the interests of the citizens, especially interests of a government that has too much debt. And so some people say, we're going to go back to the gold standard. No, why should we? Governments have no interest in gold, because then they suddenly have to be held accountable. If you want to have a gold standard, you've got to have your own.
Yeah, that's for sure. Certainly the government isn't going to go back on a gold standard if they can help it. That would certainly be a given, in my view. What do you think? You also mentioned another article you wrote is gold risk-free, and I think you touched on that a moment ago when you talked about gold isn't the answer for everything. But talk to us a little bit about that article you wrote. Is gold risk-free?
Well, the beauty about gold is it's risk-free unless and until you touch it. Then you introduce counterparty risk, and if you own it and if your daily expenses are in US dollars, you have something to worry about. The question ultimately is, how do you want to use gold in a portfolio? And just like with anything else, one has to be aware of a risk profile. If you have lots of gold, well, where do you hide it? Where do you put it? Because then you have to spend money to try to protect it, or you put it on a bank, or you put it in an ETF, or you put it here and there. They all have pros and cons. But when I refer to whether it is risk-free, I was mostly referring to the fact that if your daily expenses are priced in dollars, you're still stuck with the volatility that the price of as gold has. Now, clearly, you can think about gold just in ounces and whatnot, and I'd encourage anybody to do that. But not many people have that with the entire portfolio, and so you've got to figure out what is the role of gold in somebody's portfolio. I think it should have a very important role, but one does have to be aware that gold price can be very volatile, and so one has to be able to stomach the volatility that comes with it.
Axel, one of the topics that a lot of gold bugs are very concerned about all the time when it comes to the risk of owning gold is that government will confiscate it. Where do you come down on that topic?
Well, two things. Because we've moved further and further away from the gold standard, I don't think that's a significant risk. At the same time, I do see these concerns, and yes, I mean, you want to be flexible, and you want to be able to have your gold potentially delivered somewhere else if that's what you choose to do. But I would think that it is unlikely. If you look at any of the policymakers, they are so far removed from the concept of gold that I don't think it's an imminent threat by any stretch of the imagination. And I would think that there's going to be a little bit of warning in the sense that there's a mood shift happening somewhere that one should take notice of. So I don't have any immediate concerns. But clearly, yes, I mean, you can hold your gold abroad, and I have some of my gold in the U.S. and a lot of it abroad. Sure.
Well, certainly, that is certainly something that people think about. But as you point out, I mean, back in the 1930s, of course, we were on a gold standard, and the politicians were very much aware of gold, as were the people. And I think a very small percentage of people now own gold. What do you think the percentage of Americans that actually own gold as a store of value? Actually, you must have some sense of that with your ETF and all the work that you've done in gold. 5% of Americans,
yes,
or what?
I don't want to be quoted here on a wrong number here. I'd be on the record on a wrong number. It's a very small percentage on retail individuals that have it. So I'm glad to get back to you on that, but I don't have that number handy.
Well, it's a very small number, which means that the target audience, or the audience that should be paying some attention to the Merk Gold Trust ETF, is a very big number. But of course, to get them to do so is, it's an educational process, and most people have been educated, and into thinking that gold is indeed a barbaric relic, and we've all been trained that through our Keynesian economic courses, of course. Let me just ask you, we just got a couple of minutes left here, Axel, but with respect to the Merk Gold Trust ETF, symbol OUNZ, how's it going?
Quite nicely. I mean, it's an ETF that competes directly with GLD and IU, with a key difference that investors can take delivery of the gold. We have London bars that we store in London, and when people take delivery, if they choose to do it, we can deliver pretty much anywhere once we have identified the investor, and you can have it exchanged into coins. And in fact, when you do that, the taking delivery process is not a taxable event in itself, because you own the underlying gold in the ETF. You're just taking possession of it, and so that's a nice feature. But it is an ETF that has been trading with a very tight spread, and is you can buy it on the New York Stock Exchange. And if one day you want to take delivery, you can do it. We've had a couple of people do it. The process works. So it's one way to own gold, and we have nice volume every day in the market, but it's a product that does exactly what it says it's doing.
And it's a product that you've gained some recognition for too. I understand that you were awarded or given some award for innovation in the ETF markets.
Well, we have a patent, so we are innovators on the delivery process. Nobody has a patent that says that it is a very scalable process. So if we had 1,000 people that take delivery, we could do it. And we were nominated by ETF.com as the most innovative product for last year. So it was nice to be nominated for that. And the reason we created this product is precisely to have a solution to this, that if you want to have larger amounts in gold, or you can buy as little as one share, of course, but where do you store it? So we have a storage solution, and then if you want to take delivery, we can do it.